everyone, my name is Tina Huang. I'm a director at Queen City Law, and today we've got Roger joining us to give us his perspective on tax and accounting. Hi Roger.
Hello Tina, how are you?
Good. Would you like to introduce yourself?
Yes, so my name is Roger Thompson. I'm from Bentley's Chartered Accountants. I've been practicing for over 40 years, both as an accountant and for a period of time as a lawyer as well. And
what has been the advantage of having been both a lawyer and accountant?
Yeah, that's a good question. Generally, I find that having practiced as a lawyer for a while, I've got a much better understanding of both the accounting implications of legal documents and also the legal implications of accounting and how we should be accounting for legal transactions.
Right, so super smart, can see both worlds. So somebody once told me that there are two certainties in life, tax and death. Would you agree?
Well, look, I think that's a fairly accurate summation of life, but I'd probably add a third, and that's more tax.
Right, and so the more tax is probably killing a few people right now.
Similar situation with trusts. They've been 33% for a very long time, and then from this year they're going up to 39%.
Right.
Companies have been quite consistent for many years at 28%. Companies are now becoming quite popular, as you can imagine.
So do you think people will be using companies more so than trusts now?
Definitely. Many cases where people would hold investments in trusts, we're suggesting perhaps that they look to set up a company and put the investments into a company, or alternatively invest in tax-paid investments like PI funds where the tax is paid at 28% and you don't have to pay anything further. So,
right. But to clarify, in New Zealand there's no gifting tax?
That's correct.
No inheritance tax?
Correct.
No death duty?
No death duty.
And
correct.
No stamp duty?
That's correct.
So can you please let us know what are the different taxes that apply in New Zealand?
Yeah, so the main taxes that apply are the income tax, and remembering that New Zealand doesn't generally tax capital gains, so income is the more sort of traditional sort of income, and GST, which is a goods and services tax, which is a type of value-added tax, are the two big ones. The big ones are income tax and GST, and that's collected, along the way in a number of ways. People will have tax taken out of their wages, for example, but they might also have other income, and it all comes out in the wash in an annual return that they'll file.
Right. And so we do have capital gains tax in the form of the bright line test, right? And that went down to 2 years.
Yeah, so that's one example where something that you would traditionally think is a capital gain has been brought into the definition of income. And that's typically where a residential property, an investment property, is purchased and sold within 2 years. Now, originally, that was increased to 5 years, then to 10 years, and has now been brought back to 2 years. So there's been quite a lot of changes, and with each one of those changes to those bright line rules, they changed other definitions and so on. So it's actually quite complicated. But the good thing now, you can be quite comfortable if you've held the property for more than 2 years, you won't be caught by the bright line test. Although there are other rules that might tax the sale of property, the bright line rule won't apply if sold after 2 years.
So it went from 2 years, 5 years, 10 years, now back down to 2 years, and it's all going to depend on when you bought and when you sold.
It all depends on when you bought and when you sold. And when we look at those rules, the definitions are set, so there's the highest chance of you being caught. So in some cases, the date that you deem to have bought it is actually the settlement date, but when you come to sell it, it might be the date you enter into an agreement.
Rather than settlement date, yes.
Yeah, rather than settlement date. And certainly seen cases where people have been caught, where they signed an agreement just before the 2 years with the settlement to occur afterwards, but they still got caught. So.
Right. I just want to talk about the landlord interest deductibility. So
Yes.
under Labor's government, landlords weren't allowed to treat their interest payments as tax deductible expenses, but
Correct.
National have said that you
Yes.
can now. So can you please tell us a little bit
Yeah,
about
sure. So Labor brought in the rule that over a 4-year period, just over 4 years, 4.5 years, they were going to phase out the ability for landlords to claim interest or a tax deduction for their interest costs. And the way they did that initially they said, initially you could claim 100%, then they said from this period on you can only claim 75%, and then a year after that you could only claim 50%, and then a year after that you could only claim 25%, and then after that you couldn't claim anything. So that was the Labor plan, and they got that into place, and they got to the point where it got down to 50%, and then the national government came along and said, no, we don't like that rule. We're going to reverse it. They didn't do it immediately. They said in the next year you can go from 50% to 80%, but then after that it'll go back to being able to claim 100% of the interest costs.
So when will landlords be able to start claiming 100%?
So that actually starts next year, from April next year.
Okay.
From April this year, it's been 80%, and then next year it goes back to 100%.
And now the banks are talking about bringing a DTI. Can you
Yes.
please explain what that is?
Yeah, so that's actually come in effect, I think from July this year, where the Reserve Bank sets a rule that says for most lending that banks do, if they're for residential property, if they're lending to an owner-occupier, the maximum they can lend is 6 times that person's income.
So it's a debt to income ratio,
Yeah,
right?
it's a debt to income ratio, and the ratio is 6 times your income. They can lend beyond that, but only to no more than 20% of their customers.
Right.
For investors, that ratio is 7 times their income, so it's higher. But remember, the thing with investors is that they have to have a higher deposit, whereas a owner-occupier generally needs only a 20% deposit. The investor, it was 40%, it's just been dropped to 35%. So although you might be able to borrow more, you generally need a higher deposit as an investor.
Right. So generally, do you think it's harder for your sort of mum and dad landlords to buy property and to run it profitably because of the changes?
I think it depends on individual circumstances. I think potentially with investors that it could be slightly easier now, depending on how the numbers work out. And it is seen that for some first home buyers it might be a little bit easier to get into the market, but I suspect it's not going to make that much difference really. But it remains to be seen.
Right.
I think there'll be people on the extreme edges who are borrowing up to the max that might find they can't borrow as much as what they'd hoped to.
Right, and then they can only claim 80% of
And
the interest
that's right.
at the
At
moment.
this time,
so,
they're only
yeah.
claiming 80% of their interest. So
Yeah.
there's still some, there's still some barriers for investors that limit what they can do.
So moving on to sale and purchase of businesses. Now,
Yes.
if I was to buy a nail salon and agreed on a purchase price of
Yeah.
$100,000, that $100,000 purchase price is going to have a breakdown of different elements in there, isn't it? So,
That's correct.
and so what would that be? You have the tangible, intangible, and the stock and trade typically, right?
Yeah. So the major things when you buy a business, there'll be tangible assets, or what we typically would see as what we call fixed assets. They're things like machines, furniture, fittings, those sorts of things that you use in the business.
That you can actually
But
see.
you can see them and you can
touch
them.
Yes.
Then you have the intangible assets, which is usually Goodwill is probably a very generic term that describes that. It's the sort of the business contacts, the customer base, and there might be some special formula or process that's included in that as well. So those are things that you can't touch, but they're still of some, could be of significant value.
The name of the brand
The
value,
brand, all those sorts of things that are that generate business or allow you to generate income from the business, but they're not things that you can touch and feel.
Right. And then you've got the stock.
And then in a lot of businesses, you'll have stock, or sometimes called inventory, which is the thing. There could be things that are being sold or things that get used up as part of the process. You know, in your example of a hairdressing salon, it might be some stuff they put on the hair.
The hair dye.
The hair dye, those sorts of
products,
things.
Yes.
As you can see, I don't use a lot of those products.
So,
not top of minds, but
parties often agree on the price, but then
yes.
they can disagree on the breakdown, can't they? So
Yeah.
why is that?
Yeah, so typically there's tax implications on the sale of stock. So if you sell your stock, that's generally income. If you sell the fixed assets, the plant and machinery, furniture, that sort of thing, normally businesses have claimed depreciation on those items, and if they sell those items for a certain price over their book value, then they may have to pay tax on that.
Right.
Whereas the sale of goodwill is generally tax-free.
Right.
So you can see that somebody selling a business, they probably want the goodwill to be as high as possible.
Right.
And the stock in particular to be quite low if they can justify that, and also the fixed assets to be low. Whereas a purchaser of a business, they will generally want to have the stock high, because when they sell that stock, they will get a full tax deduction, and they probably want the fixed assets to be a high value as well, because then they can claim depreciation deductions. So the purchaser and the seller are sort of diametrically opposed on how they would like the purchase price to be split between those items.
But it's important, isn't it? Because there are those tax and accounting implications. So they need to get accounting advice before they agree on that, don't they?
They should get accounting advice.
Yes.
And for many years, I think there's been a bit of a practice where the parties wouldn't agree on anything, and they would just do what suited them in their own tax returns. And of course, our Inland Revenue Department realised that they weren't getting the corresponding treatment or consistent treatment across both parties, and so it was really Inland Revenue who was paying the difference there. So there are now some quite a procedural process set out in sale and purchase agreements where the parties can agree on the split of the purchase price, or if they can't agree, there's a process that gets followed so that both parties are treating their item the same in their tax returns and not doing what suits them individually.
Right. And when parties are buying and selling a business, from a legal perspective, it's very important you get the contracts right, because you're not actually just purchasing a business, you're being assigned a lease, and then there are other contracts that often are assigned, and then there's employment issues that you need to work through. What other issues might a purchaser need to be aware of when they're purchasing a business from an accounting or tax perspective, do you think?
Yeah, I think there's from an accounting and tax perspective, it's really that allocation across the items being purchased, which is the main thing. They're obviously also taking over other contracts and employment contracts, those sorts of things, as to, are you taking on any liabilities with those? That needs to be looked at quite carefully.
And then being GST registered, of course.
GST registered is very important.
Yes.
Generally, from GST perspective, the sale of a business will be zero rated as a going concern, but there are some issues that need to be ticked off really to make sure that applies.
But if you had a business that hadn't been trading for some time, then that could affect the taxable supply element, couldn't it?
Yeah, possibly.
Yeah.
If it's not been a going concern, or only parts of the business are being bought, then that could also mean that you're not really buying a going concern. You're just buying a particular asset, so you might have to pay GST on it, as opposed to it being zero rated for GST.
Right. So that's a small snapshot of some introduction to tax and business elements that you must be aware of. As Rogers said, that there's a lot of transfers now happening from trusts to companies, and when you do that, there could be tax implications to that. So we highly recommend you get good legal and good accounting advice before you proceed. So thank you, and watch out for our second video on GST.
Thank you.